Let's bring in Ed Egilinsky joining us this morning, Managing Director, Head of Alternative Investments at Direxion, to help us focus on the fundamentals and shift away from the technicals a little bit. Ed, good morning to you. Happy Monday. I'd imagine gold pretty comfortable at these levels, but I'd imagine squarely focused on yields. We went out at 4.25% last week with the 10-year.
Yeah, I mean, if you look at gold, Ben, it's interesting. Despite the headwinds of higher rates this year, a strong dollar, gold still relatively flat.
Yeah.
So, it's interesting to me. I think the path is higher as you looked at from a technical standpoint. You have a lot of geopolitical risk out there, whether it's the Black Sea, the Red Sea, a U.S. election year. I think there's going to be a higher floor under gold as a result of that. And what's interesting, Ben, also is if you look at central banks, net buyers over the last year into 2024, but from a retail standpoint, if you look at U.S. gold ETFs,
they've been on decline.
You see net outflows, and right now you have gold bullion basically at 10-year lows in terms of what ETFs are holding. So it's a mixed picture there. But to me, I would lean more towards the central banks providing the strength relative to the retail investor signaling outflows.
Silver ETFs, I'm hearing, have seen outflows as well. And I want to talk more about the metals in just a second. But first, just commodities in general. Talk to us a little bit about the recent inflation data, stronger than expected CPI, PPI. We mentioned the core PCE focus this week on Thursday. What does this suggest to us about the broader commodity markets?
Well, definitely inflation remains persistent. That's for sure. That PCE number is going to be huge on Thursday because supposedly that's the biggest economic indicator inflation data that the Fed looks at. But Fed fund futures, Ben, keeps being pushed out in terms of when rate cuts are going to start. Now you're talking mid-year. They were talking multiple cuts. Now there might be only 2 or 3 cuts. I think overall, though, commodities might rally from a broader perspective. And it's because of the geopolitical risk being center stage and the impact it could have on supply chain issues, keeping inflation elevated. And I think that 10-year, Ben, we could see 4.5 tested and even north of that.
Talk to us a little bit about metals here, getting back to and focusing a little bit more broadly on, well, the economy here in the U.S. and internationally as well, because we have some numbers coming out a little bit later on in this week. China, we've got some PMI numbers, Japan for that matter. We're going to get a look at some CPI data there as well. But one thing that we saw last week was a significant rally in Chinese equities, right? We mentioned at the top of the show, I think it was the CSI 300 snapping a 9-day advance. But does that equate to copper prices, for example? Is there opportunity there? If we start to see China's stock market recover, should copper follow suit? Because we remind our viewers, and I think it's important to point out that equities do not equal the economy, right? The stock market does not necessarily reflect directly the economy. There can be other contributing factors. And for one of them was some of the bans on the short selling on the open and close we saw.
Yeah, no, definitely. You look at China, it's been a tale of 2 months in terms of the equity markets. January was down severely, and February you've recovered dramatically to where now the FTSE China 50's up a little bit year to date. I think a large part of that, Ben, is due to the PBOC cutting mortgage rates to stimulate housing. They just did that about a week to 2 weeks ago, maybe a week ago rather. To stimulate a struggling housing market. I think that continues to be a major focus in China as well as their recovery. What's interesting is we just launched the 2X Bull product on the MSCI ex-China. There's a lot of flows going into emerging markets ex-China right now. I don't know if that's a contrarian indicator, but certainly China has underperformed the broader EM markets as well as, of course, the U.S. markets on a 1, 3, 5, 10-year basis. Valuations are getting cheap. What does this mean for copper potentially? I think you need the Chinese market to continue to show any sort of signs of life from an economic standpoint. That's the only way I think you're going to see copper meaningfully break 4. And I think that's a major, right now, resistance level still.
Yeah, we're talking quite a bit about China, lack thereof in terms of opportunity helping and benefiting some of the other areas of the world, right? For example, U.S. stocks. I mean, we've seen them beneficiary thereof, again, of lack of opportunity. Let's talk a little bit about silver. Mentioned some of the ETF outflows that we've seen coming into play, but what's it going to take for silver to finally break through some of the resistance we're seeing, some of these key levels to the upside?
Well, you just talked about it with gold. I think it's even more pronounced with silver. It's pushing against its 50 and 200-day moving average. Can't break above those resistance levels now. I think from a short-term trading perspective, you're talking about 22 is your floor and 23.5 to break out of that short-term trading range. But when you look at silver right now, it is cheap relative to gold. We've talked about this on the show before. The gold-silver ratio right now is roughly at a one-year high at about 90. Historically, it's been about 70. So right now, silver is cheap relative to gold. Can it go cheaper or can it get cheaper? Sure, it can. I think the key with silver, outside of maybe participating on that flight to safety indirectly with gold, will be solar energy adoption, the continuation of that. You have 10-year global supplies with silver being pretty stagnant. You get any increase in demand, Ben, particularly from the solar side, that could really bode well for silver. But right now, it looks like if it can't break above that 50 and 200 day, you could see lower prices with silver.
Ed, talk to us about, well, you mentioned the 2X gold product. Talk to us about how the Comm ETF is currently positioned.
Yeah, the Comm ETF right now, we're long 4 out of the 12 positions. Gold and silver still positive trends there. Heating oil, and we just added right now cotton. So we're long 4 out of the 12 positions. It is a rules-based type of strategy. It is unique in that it doesn't always have to be 100% static long. And we get paid to wait right now. Cash is paying something. So 8 out of the 12 commodities right now are in cash because price trends dictate. So we'll see how it plays out, but there's always seems to be some opportunity in the broader commodity space. Right now, silver and gold are among the 4 that were long based on price trends.
Yeah, it looks like it's kind of teetering right around the 50-day moving average here. If we can just pull up the chart here, it's much like gold. Again, that chart that we pulled up kind of sideways here, consolidating right around and just below this $28 level.
Yeah, I mean, listen, with Comm, I look at it more as a strategic asset allocation, long-term hold. We're going to do the heavy lifting for you in terms of the commodities to be longer in cash based on price trends. But if you're looking at it from a technical standpoint, yeah, definitely right now, it's got to hold serve where it is, and hopefully it'll push higher.
Yeah, well, we'll continue to watch commodities for that push, ultimately. Gold, silver to regain some of those upper levels here. I'd imagine that would help. Ed, I appreciate you joining us here, helping us start the week with a look at metals. Ed Egilinsky, Managing Director, Head of Alternative Investments at Direxion.